welcome back to another Random Gleanings. Today is December 5th, and Chris, we just missed the announcement, and it's a sad announcement. Last week came up after we recorded, but one Charles Thomas Munger passed away last week.
At 99 years of age, Warren Buffett's right-hand man.
That's right. I recall you sharing a Charlie Munger quote very quickly after I started working with you, and it's always stuck with me. I've heard you probably say it 100 times since, but
guy was brilliant, just plain spoken. The quote was, "It's amazing how well we've been able to do just by trying to be consistently not stupid instead of very smart." And he's got a ton of other ones too.
Yeah, so I found these 10 quotes. They were considered salty quotes, and they do have a little salt to them. So number 9 and number 2 were two of my favorites. And of course, number 1 is something that I just really like. Apparently, he ended up there nonetheless. He said, "All I want to know is where I'm going to die, so I'll never go there."
That's right.
So,
that's exactly right.
God bless him.
If you need a Christmas present, you can look it up on Amazon, but Poor Charlie's Almanac is there, and it's pretty outstanding. So rest in peace, Charlie Munger.
Indeed.
So last week we talked some about forecasts for next year. Here's a list of price targets coming out for 2024, and a lot of them are lower than where we are right now.
They are. I think we did something like this last year about this time, and the point to me is the discrepancy between what very smart people on Wall Street believe will happen next year, right? And we can look, this next slide shows that same discrepancy over what folks were saying at the end of last year for this year. And so I would encourage folks not to put a whole lot of credence in any of this stuff.
Right. It's just interesting to see where everyone is.
It certainly is.
I mean, right now we are trading at 45.66 on the S&P. Today is December 5th, and it's about 11:30 in the morning. So, I mean, there are only a couple people on this list for 2023 who are looking like they could be right. Right now, Deutsche is the number 2 on that list, and they're right in that vicinity. Tom Lee's, of course, above where we are right now, so we'll see. But it's all going to be interesting because as we look at the next chart, so this guy, I assume it's a guy, the Kobesi letter, I mean, this dude is always bearish, always. I mean, it's just super negative, but I saw this, and to me, this really sticks out, right? Because it just shows you how sort of diverse things are acting, right? Stocks are up like we're in a bull market, right? And I mean, it does look like, more of a resurgence kind of market, especially we've had 3 distinct periods where breadth, a lot of participation has occurred. And then there have also been periods where the average stock just did nothing throughout the year.
That's right.
And the average stock is still very much low single digits on the year. Gold is up like we're heading into a recession. I mean, the rest of the world's central banks have been buying gold over the last 18 months like it's going out of style, which is really fascinating. I mean, obviously they think we're going to have more reserves issue or something. I can't explain.
That or a move away from the dollar more internationally. But either way, gold has historically acted like this in a run-up to a recession.
Yeah. And there's definitely been interest in momentum there. Oil prices up like there is no recession or like the recession got canceled, right? Of course, there is no recession at this point. It's just, but the yield curve's still inverted. I mean, it has been, and this is right in that window where historically something normally would start. Bonds are up like inflation's back below 2%. It's not. Home prices are up like inflation is still at 10%. I don't know that I necessarily agree with that statement, but I will say that home prices, especially existing home prices, are definitely up. So, I mean, everything's up, and it's, is it for the wrong reasons, or is it just really cross currents and it's hard to tell? I think it's
kind of a culmination of everything that happened post-COVID, right? And
right.
That's what has been so challenging and why those price targets were so widely distributed across at the end of last year looking forward to this year, and why they can't necessarily be trusted, because these things are just hard to pin down right now.
Yeah. So next chart, Liz Young pointed out this morning, we got the job openings report this morning, and October job openings came in at 8.7 million, well below the estimate of 9.3 million. Continued cooling normalization of the labor market and wage growth yields down on the news. Okay, so you'll recall the jaws that we talked about forever, the difference between the unemployment rate and the job openings rate.
I recall we were talking at some point about 2 open jobs for every unemployed person looking for a job.
That's right. I mean, unemployment was at 5.6 million and job openings crested at 12 million, which you'll see on this next chart here. Job openings as of this morning are 8.7 million, which is 27.7% fewer jobs since March of 22. I mean, that's less inflationary. I mean, you could also argue, well, maybe that's not good. But I mean, it is good. I mean, it gets back into normalization. Unemployed persons bottomed at 5.6 million, now at 6.5. That number is technically up 16%, but that's how much of the existing workforce that now might not be unemployed as a result.
I think we ran the numbers at about 0.5%. Yeah.
So in terms of people who are at normal work age and employable, 0.5% fewer have a job.
Yeah, that number totals out to about 167 million people. So this 900,000 makes up about 0.5%.
Okay. Well, I mean, I think most would consider that positive because it's less inflationary, right? And that's good. But now, I mean, what you're starting to see is rate cuts abounding for next year. But I mean, I remember back in 2000, 2001, and maybe it's good, maybe it's a curse. It's felt a little more like a curse to have any memory of the past this year, just because stuff hasn't acted like it acted in the past.
Letter.
That's right. That's right. So here's Bob Elliott's tweet. If you love bonds here, and Bob Elliott, again, was one of Ray Dalio's right-hand guys at Bridgewater, largest hedge fund in the world. If you love bonds here with 5 cuts already priced in for 2024, then you must really love being short stocks. What does he mean here?
He means that if the Fed's really going to start, chopping away at the rates,
things must
probably
be bad.
Not for the right reasons that you should be excited about.
Right. I mean, things must be bad for stocks. And that's kind of what happened in that 2001 type time period, right? They cut rates pretty heavily. Unemployment was rising. And ultimately, I mean, stocks just couldn't keep pace. And I mean, the economy fell off.
Yeah, I mean, the Fed has been saying for a long time, rates higher for longer, and the economy has weathered that to this point. Now, I think that there's some that are estimating that the market's looking ahead to these rate cuts. But again, if it means that the economy has slowed down, perhaps stocks don't compete as well in that environment.
Yeah, it means either bonds are right and the Fed funds futures market's right and stocks are in trouble, or it means that the bond market's wrong and that we're not going to cut. In which case, the question is, and then maybe you don't get much of an issue from stocks, but maybe what you get instead are interest rate rises, or at least rises on the long end, sort of a flattening out of the curve. So somebody's wrong.
We will see.
Yep.
We will see.
Meanwhile, if you look out at comparisons of lower quality bonds versus very high quality bonds in terms of U.S. Treasuries, the higher this line, the more risk or stress there is in the financial system, right? Mm-hmm. Right now, you're sitting here bouncing along a low point in the near run for the riskier side of the bond market, which would imply then that, risk just really isn't showing up yet.
Yeah, and we don't have this chart, but the VIX is kind of saying the same thing. And there's those that make the argument that there's complacency built in, and that there still has to be some catalyst to move it off of that. And so those things are unpredictable. But at the same time, this has not looked terribly bearish right here. Right.
And in fact, if you look at the Dow Jones Industrial Average, it just had the second highest monthly closing out November ever. I mean, it's tough. It's only 30 stocks, right? I mean, the S&P 500 obviously has a whole lot more, but second highest monthly close is not insignificant. And then finally, if you look for the month, technology had a new all-time high in terms of the market cap sector, just tech specific. And as you know, tech is the largest sector in the S&P 500 at nearly 29%.
So as goes tech, goes the S&P pretty much.
Yeah, and the point that JC and also our charts are trying to make here is, look, I mean, if there's a new all-time high for tech, with tech being 29% of the index, don't you expect the index to follow to a new all-time high as well, which we're now, what, a couple percent?
Yeah, I think 3 to 4%.
Yeah, away from a new all-time high. So we'll see, right?
We will see.
Yeah. You got anything else?
We back to a recommendation real quick. The Chris Stapleton new album it's funny, man, because I was not a country guy,
right?
But that dude can sing. He can sing.
So we just started watching a new Taylor Sheridan show on Paramount called Lawman Bass Reeves. It's about a slave that goes out west and becomes a lawman, and we've only made it through the first episode, but like all things Taylor Sheridan, it's a little bit rough. It's a little bit, glad we're not living that life back in,
1800s or something like that. Yeah.
Man, holy cow, but it's so good.
Yeah. Okay. You said Paramount?
Yep.
All right. Well, let's check that out.
Yes, indeed. All right, friends, thanks as always for watching. We're grateful to you. Please do click the subscribe button, click the bell to be notified when we post. I'm telling you, it's worth doing that because then you can just click on it and know what's going on, right? Thanks as always for watching. We'll see you soon.
R.I.P. Charlie.